Hello everyone, welcome to another weekly market news session. My name is Carl Capolingua. I'm the market analyst over here at ThinkMarkets Australia, and it is a pleasure to be with you as we delve into all of the key moves in markets from last week and have a look to the week ahead. Let's get started with a look at the crypto markets first, and it was a sea of red last week. You can see biggest falls coming in Terra. Now that has been one of the high flyers over the last 6 months, down 22.6%, but sharp falls also in other DeFi high flyers, Solana, Polkadot, the majors there in Bitcoin down 10.2% and Ethereum down nearly 10% as well. And as we start to look at some of those monthly declines, you can see that we've seen anywhere between sort of 1/5 and 1/3 knocked off those crypto majors. Bitcoin chart on its screen now, we can see that the short-term trend is very much well established to the downside. That's the light pink zone. Long-term trend also down. We broke through the key support level there at 37.017 during the week, and a very subdued performance since then. In fact, we broke through 34.329 as well on the current candle. 32.992 now is the key level of support, and after that 28.754, 29.992. There's a bit of a band there from a few previous lows actually in the middle of 2021. We are seeing some slightly elevated volume, which does tell me that there is a little bit of demand sneaking in to take advantage of these lower prices, but until the price action turns, so a series of white candles and or lower shadows at the very least, I wouldn't be brave enough to allocate any capital to Bitcoin just at the moment. Indeed, if we look at the fear and greed index, we are now at 18, extreme fear. That's down from 22 last week and down from 37 a week before. I know that many of you would argue that it's better to do the opposite of that, but I think given the price trends and the well-entrenched nature of that, it's best to just wait and see. Having a look at Terra now, just because it was obviously the largest faller out of those majors during the week, can see it has taken out that long-term uptrend zone. Price action, very much lower peaks, lower troughs, short-term trend to the downside. And now that we're below that long-term trend zone, we really do need to see how the price action behaves from here. If we get a bunch of black candles or upper shadows into the zone, it would tell us that this bull market in Luna is over, and we are at the very best a sideways market, at the worst the beginning of a potential bear market. If, however, we can get above that dark green zone very quickly with a bunch of white candles, then I would say this break is more of an aberration and we can continue the uptrend. I'll let you decide what is the most likely scenario. A quick look at Ethereum, 24.45 continues to hold. It does look slightly better than Bitcoin in that it has not broken down some of those key levels. But having said that, the short-term trend is very much well established to the downside, and that long-term trend, to be fair, is starting to turn and confirm a bear market in Ethereum. 21.63 is the key level of support, 2300 before we get there, I guess. We don't want to see a break of that because that will cause a test of those July 2021 lows at 17.18. Now, before today's session, I had a quick flick through the top 100 crypto charts by market capitalization. I found only 3 worth bringing to your attention, even then struggling to find a screaming buy. But Monero, that's the privacy coin, it's done well since Russia's invasion of the Ukraine. Some thoughts there that Russians might be using it to move capital around, trying to hold on to its long-term uptrend zone. The short-term trend is down, but I would suggest a close above 230 would see this holding that long-term trend zone and actually starting to look pretty good again. The next one is TRON. Now, this is a layer 1 protocol, which is aimed at helping artists, both digital artists and real-world artists, monetize the intellectual property. Nice pop through the last couple of weeks with some massive volume. Now, that volume is just telling us that there's plenty of interest in TRON at the moment, and that's a huge departure from so many of those other cryptocurrencies. So that's a big tick in itself. Candles maybe at that sort of handle there around 9, not looking fantastic, bit of supply in the system, but holding pretty well, to be fair, those recent gains. I'd suggest if we can get a close above 9, it's probably worth having a closer look at this one. And the final one today is XDCNetwork. This is one of those financial services DeFi focused protocols. Look, it's not exactly a long-term uptrend, but at least we've got a short-term uptrend, and that's way more than we can say about many of those other cryptos, and I like the fact that there is actually a bit of interest building in this one as well. I'd say a close above this high here, and let's just call it a 7 handle, would actually have this one looking pretty good as well. And bringing it back home now, we can see the S&P ASX 200 down about 3%. None of the sectors were spared, falls across the board. And that's actually pretty rare, because generally there's one sector that manages to eke out a gain. Utilities almost got there, down 0.3%. That was the best performer. But if we look at the worst, real estate trusts, now they don't like rising interest rates. They were down about 8%. Technology next worst there, one of those key risk-on sectors, down 6%. Gold down 4%. Gold prices falling a touch. We'll talk about those later. And then discretionary, a sector that is highly dependent on consumer spending, in the face of rising inflation, down 4%. Having a look at the technicals, we can see Friday's large black candle taking out Thursday's gains, but really just following on from a poor performance there Monday, Tuesday, Wednesday. We took out that 72.83 low. That's important because it really does put us firmly back into this lower peaks, lower troughs pattern. And that unfortunately speaks to sell the rally activity in the market, not buy the dip. In fact, if we were hoping for buy the dip at the long-term trend zone, that clearly hasn't happened, and really it's only 71.98. That last peak there from early March holding us up. Close beneath that is decidedly bearish, and we could come down and see 69.59. What could turn it around? Once again, we need to see those white candles, lower shadows, and preferably a move back above that long-term trend zone as well, but not looking great for Aussie equities. As we look across the region, Nikkei was up a little. Now that was more to do with an abbreviated trading week rather than positive mood over there. We did see the rest of Asia down, in particular Hang Seng down 5%, Shanghai another abbreviated trading week there. On the face of it, it doesn't look like a huge decline in US shares, but they were up big at the start of the week. We'll investigate why in a second, and some pretty sharp falls towards the end of the week, wiping out those gains and more. Volatility up 10%, Europe down anywhere between sort of 1.6% there on the FTSE to 4.2% on the CAC in France. Having a look at some of those key US indices, we are just holding on here at 4062 on the S&P 500. Obviously the 4000 handle is not far away, and I do believe it's going to be key in defining whether we stay in, well, it's not really a bull market anymore. To be fair, I think the bull market is officially over. I think it was over sort of on this break around here, February, March. You could say even this failure back through the zone here more recently in late April. But I'm yet to declare a bear market. Now, if we close below that 4,000 handle, then I think it would be hard to argue we're not in a bear market. From there, a pretty slippery slope into 3,700. Having a look at the NASDAQ, this one is in a bear market, I do believe. That long-term trend zone, in fact, is about to officially swing to the downside, but there's more than enough in there to call it a bear market, with that long-term trend zone impeding prices at least a couple of times. The short-term trend well established to the downside, clear lower peaks and lower troughs in the price action, and the candles skewed towards the supply side as well. We are holding, however, at 12,074 on that 12,000 handle. Beneath that, not a lot holding us up until 10,519. What could turn this around for the bulls? Again, bunch of white candles, lower shadows, and hopefully a push back above 12,985. So a 13 handle, and this is going to start to look interesting for one of those V-shaped rallies potentially that we've seen so many times on the NASDAQ perform. A quick look at commodity prices now. We can see a very tough week for the industrial commodities and the precious metals as well. Probably the most important ones though for Aussie stocks. Iron ore down 5.4% in Singapore, that's the US dollar price. It does look like there was a gain there in China, but again, we did see an abbreviated trading week, so that's less about demand and more about it didn't trade on the really bad days. From there, copper down nearly 4%. That's not great either. Then we'll have a look at that chart after this one, which is iron ore. We can see that we're moving from this recovery phase here, short-term uptrend, price action getting above the long-term trend and holding above it. But as the lockdowns in China continue to bite, we've just seen the strength just ebb out of the iron ore price. We've moved back into lower peaks and troughs, and the candles, well, whenever you see these big black candles, that's never a good sign. And I think a close below 133 would be decisive in swinging us back into a bear phase. 125, 115, potentially the next targets to the downside, but it doesn't look good for iron ore at the moment. Doesn't look good for copper as well, because we broke below this key uptrend zone. Now, that in itself is not a total disaster, because if we see copper reclaim that zone, say with a close above 10,000, it's just a short-term aberration. However, if we start to see a bunch of peaks being put in their zone, that would tell us that the long-term uptrend zone, which has been so supportive, is now starting to resist prices, and you only have to go back to that NASDAQ chart to see what happens once that starts to occur. Having a look at nickel, look, this is a bit of a sideshow at the moment because it was so impacted by the events in the Ukraine. I would suggest we're probably heading back to that long-term uptrend zone around about 28,000. Gold, as I said, not a fantastic week. Normally it gets a bit of a bid side when markets go risk off, and they were very risk off last week. We saw a very mild performance from gold, and I think a few of the gold bulls starting to lose faith that gold has the right stuff in the current macroeconomic environment. Short-term trend certainly well established to the downside. Long-term trend only just holding. Break below 1849, I think, would be decisively bearish. Having a look at the price of crude oil now, a nice close there above that medium-term peak there at 109.20 on Friday's session. Short-term trend starting to swing higher, long-term trend well established, and this one looks pretty good for me. You know, we closed out the week with nearly 6% gains in West Texas crude and Brent, and natural gas also surging as well. That chart looks very good too, up 10.2%. Aussie dollar finished out the week slightly stronger, but you can see it's down over 5% for the last month as the US dollar continues its rally. The biggest and most disturbing move on that slide, however, in fact, in terms of anything we've seen today, has to be here in interest rates. The Australian 10-year yields rising 32 basis points in the week. That is extraordinary. I cannot tell you how extraordinary that is. It just speaks of major dislocations in the markets at the moment, and US 10 years up nearly 21 basis points as well. We did, of course, see a couple of interest rate rises during the week in both of those jurisdictions. We'll talk about that in a second, but markets should have already factored those rises in. So it's not a case of those moves are in response to the increases in official interest rates. Rather, those moves are factoring in further moves down the track. All things being equal, in a week where you do get interest rate rises, you really shouldn't see any moves in those bond yields because they should have been factored in. Hey, if this was a stock chart, you'd be buying the hell out of it, but it's not. It's the price of money in the longer term here in Australia, and at 3.5%, we are well off where we were at the start of the year at 1.5%. I'm going to put to you it's an unprecedented move and challenge you to find a time in history we moved further in such a short space of time. Having a look at the US, and I've gone to a weekly chart here because I wanted to show you where quote unquote normal is. And really, interest rates at the moment are all about this race to normal. It's about central banks removing that extraordinary stimulus that we've had post-COVID. Yes, they had to get that stimulus in place to stave off a far deeper recession than what we actually got. In fact, we've seen economic growth, we've seen unemployment return to pre-COVID levels. In fact, in many jurisdictions, actually be lower than pre-COVID levels. So, full ticks there for central banks. They've helped out a bunch of people around the world. But those ultra low rates obviously couldn't stay there forever, and they have to go up. And central banks are talking to us now about normalizing those rates. So if all this pain is being caused by these rising interest rates getting towards normal, how close are we to normal? I guess that's the idea here. And we can see that, we're pretty close to the highs, pre-COVID highs back there. They set late in 2018, just before a bit of an economic downturn, to be fair. But we're at the top end of the range. And if you look at sort of the last 20 years, these yields in particular have been trading in a band between sort of 2.5% to 3.5%. So as you can see, we're getting towards the top end of that range. And probably over the last 10 years, probably more between sort of 2.5% and 3%. So if that's the case, we're actually above what would be considered normal. And many people would argue that above normal is because of the above normal inflation we're seeing at the moment. So I think we're pretty close there. But for risk on markets to recover, I'm talking, stocks here, commodities, we will need to see a high put in here. And what is that high going to look like? Well, it's going to look like some black candles, like the ones we saw here, something like this, a nice reversal where we start to take out previous troughs and not make new peaks, really, isn't it? And let's have a quick look at some of that key macroeconomic data from during the week, starting with liftoff here on Australian rates. The Reserve Bank of Australia increasing the cash rate by 25 basis points to 0.35%. Now, that did surprise the market a little bit. We were expecting a 15 basis point rise to just 0.25%, but the Reserve Bank clearly seeing the urgency, saying now was the right time to begin withdrawing some of the extraordinary monetary policy that was put in place to help the Australian economy during the pandemic. They also upped their forecast for Australian economic growth for the next 12 months to 4.2%, and that is a very strong economy. Unemployment is likely to fall to 3.6%, very low indeed, and wages growth to be quite healthy at about 3%. Now, that is obviously going to give Australian consumers some comfort in dealing with higher inflation and also potentially with their higher spending levels to continue to keep our economy ticking over. Core inflation is expected to hit 4.6%, and that's up from the current 3.7% and still well above the Reserve Bank's 2 to 3% average target over time. Reserve Bank Governor Philip Lowe said that a 2.5% cash rate would be quote unquote neutral. We've obviously discussed this idea of neutrality. The market on that basis is now factoring in another 25 basis point hike in June to 0.6% and a cash rate of 2.75% by Christmas, so potentially overshooting Philip Lowe's target. Having a look to the US now, and they had their own interest rate increase. The Federal Reserve increased the Fed funds target rate to 0.5% to 1%. Now, that is an increase of 50 basis points. Markets initially cheered that 50 basis point hike because they were expecting as much as 75 basis points. When it didn't come, markets got excited. Of course, we saw markets sell off heavily into the end of the week, and that was because they started to look ahead to the next meeting where, you guessed it, now they're expecting a 75 basis point hike. The Federal Reserve also announced that they would start to reduce the size of their very large balance sheet by about $47.5 billion per month starting from June. As I said, markets now weighing a 75 basis point hike at their next meeting. And the impact of all of this on the US economy is in that last point below, where it says that we have seen a move in US mortgage rates from about 3.3% at the start of the year to 5.5%. And that potentially is going to take a big chunk out of consumer spending. And non-farm payrolls is typically the biggest data release in any month, so it normally doesn't go last, but it's unusual to have, the Federal Reserve meeting in the same week. We did see some continued solid growth in the US employment market, 428,000 jobs added, roughly in line with the previous month and well ahead of expectations. Last month was revised down slightly by about 3,000 jobs, but nothing to be too worried about. The trend, I would suggest, is a little bit softer over the last 6 months, but we're still, give or take, double the usual sort of monthly gains in employment from pre-COVID. So all things considered, it's still a very strong jobs market in the US. Unemployment rate tailing off there at 3.6%, holding with the previous month. And the participation rate is probably the key data point on this chart, because we saw that actually fall from 62.4% to 62.2%. Doesn't sound like much, but it equates to a loss of 363,000 jobs from the US economy in a labour market that is extremely tight already. So that potentially is going to hamper US growth down the track as well. Okay, let's have a quick look at some of the key data metrics for the Australian market. We can see that the S&P ASX 200 average 1 year forward PE is currently at 15. Now that is well down from its post-COVID peak of 20, and it's well below where we've typically seen your major corrections from. So I'm talking 1987, I'm talking 2007 GFC. Typically, those markets have seen 1 year forward PEs in excess of 20. So with hindsight, and hindsight's always perfect, you look back and you say, of course, stocks were due to crash because they were too expensive. What we're seeing now with the current, and we're certainly not in a crash, but decline from the highs, is that the market is actually pretty well valued. Typically, we'd say 15 is fair value, 10 is cheap, 20 is expensive. So if we do see a decline, it is actually not from an expensive market. So that's encouraging. Look, I'll let you hit pause and have a look at where some of the sectors are compared to post-COVID peaks, where they are to pre-COVID peaks. That's 3-year average before COVID, and whether they're looking cheap or expensive in your view. Having a look at the technical analysis, market breadth now, and this is just measuring how many stocks are still in uptrends or downtrends over various technical analysis look-back periods. So 5 periods is 1 week, 2 weeks, 1 month, 2 months, 3 months, and so on, out to about a year's worth of data. And we can see that very, very few stocks now are in short-term trends of up to about a month, and we are really at 40% or less on those long-term trends. We can see we're well down from the previous week and well down from the bull market high. So long story short here, a healthy bull market has a participation rate of around about 2/3 of stocks in uptrends, pretty much flat across the board. We're not seeing that now. We're seeing, only about 15% of stocks in uptrends in the short term and only about 2/5 of stocks in uptrends in the long term. And it appears to be getting worse, but we are still well above, of course, the COVID lows. And that is extreme bear market territory sort of down here. Having a look at the sectors now, growing increasingly red, certainly from last week and the week before. The ASX 200, in fact, now in a short-term downtrend. Long-term trend, I have to call it neutral because we've closed beneath that long-term uptrend zone. Discretionary, that's been consistently down. You'd be avoiding that sector. Energy, up. I still like that. It's very strong there. So continue to look at some of those energy stocks. I had a look at the chart of Terra, ticker code TER, Beach Petroleum, BPT, and Worley. The engineering contractor has a lot of exposure to the energy market here in Australia. Those charts looking pretty good. Financials, short-term trend has swung to the downside. Long-term trend still hanging in there. Gold, it just doesn't look investable again, which is disappointing considering how good it was looking not that long ago, down and neutral. Healthcare suffering during the week. It was starting to get going also, back to neutral and down. Technology is stuck in down. I don't think you need to be looking there anytime soon. The material sector, so our resources stocks, starting to worry me now. We've gone short-term down and the long-term trend is starting to come under a little bit of pressure. Property back to down. That's disappointing also. Staples, one of those key defensive sectors. So I'm talking sort of Coles, Woolworths, Endeavour, all looking very good. I think you can stick with those. Telecoms down. They got hit last week. I don't think you need to look there. And utilities, still pretty happy with those. So AGL, APA and Origin would be the key picks in that sector. Okay, let's have a look to the data for the week ahead. We've got the NAB Business Confidence Survey coming out today and the Westpac Consumer Sentiment Survey out tomorrow. Not hugely market moving, but certainly ones to keep an eye on. And then heading overseas, everything would pale into comparison, I'm going to suggest, to the US CPI data. That's the consumer price index, so inflation data at the consumer level, and then inflation data at the wholesale or producer level there, the PPI, and then some consumer sentiment surveys coming out towards the end of the week. Well, that's it for me today. You can join me tomorrow in Ask the Experts at 1 o'clock Sydney time. You get your portfolio questions answered. I'll give you a quick technical and fundamental on any of the stocks you're interested in. That's where you can register. Of course, this presentation is being brought to you by ThinkMarkets. We do have a huge range of products that you can trade here on the local market, but we do also offer international shares, CFDs, indices and commodities by ways of contracts of difference if you're interested. $8 CHESS sponsored trades on your local shares, 24/7 customer support, and of course a world-class trading app. Head to the website for more details and to learn how to open an account. If you're watching me on YouTube, please hit the subscribe button or the bell icon to stay notified of any new videos we put out, and smash that like button to let us know you love what we do. We'll keep doing it. Well, that's it for me today. Thanks for joining me on this quick look around the markets. All the best for your investing until we catch up again. Bye-bye for now.